Welcome to the deep dive. Ever wonder how those, incredibly complex automated systems handle high-stakes situations? Like in finance, making split-second calls to not just make money, but really hang on to it and manage the risk. Well, today we're kind of pulling back the curtain on exactly that. We're doing a deep dive into a pretty advanced automated trading framework. It's called the OM-NI Profit Nexus Protocol. And what's really cool is we've got its actual operational plan for a specific day, Friday, September 12th, 2025. It's like getting a snapshot of a very disciplined financial brain reaction. Our sources, they're a detailed set of documents. They outline how this system, which uses things like AlphaCore v4.0 and DOTAS v2.0, sees the market, sets its plays, and crucially, manages risk.
Exactly. And our mission today isn't just to read the rules off the page. We want to really unpack the logic, get the why behind the what. What principles are driving this thing when it comes to protecting profits or setting its targets? What's most important to it? What lines won't it cross? And maybe most importantly, what can we all learn from this really structured way of dealing with, well, uncertainty?
Okay, let's jump right in. The system status is labeled post-perfection regime adjustment. That sounds intense. What does post-perfection even mean for a system like this? And what kind of adjustment are we really talking about?
It's a fascinating phrase, isn't it? Post-perfection regime adjustment. It suggests the system hit a really good streak, maybe some top-tier performance, and now it's actively shifting gears, not just to keep things going, but to really lock down that success. The main message is crystal clear. Preservation first, convexity second. Yeah, it's in live trading mode, but the big focus right now is the profit protection protocol.
Okay, preservation first. So how does that translate into actual actions right now?
Well, first, it's doing something called aggressive profit banking. And this isn't optional, it's an immediate command. It locks in 50% of all unrealized gains right across its main holdings, SPY, TSLA, and BTC. Boom, half the paper profit is banked.
50%, just like that. Okay, what else?
Second, there's exposure reduction. It's position sizing back by about 30% from what it normally does. It's trimming things down to what it calls a low convexity mode.
Low convexity mode. Okay, that sounds technical. Can you break that down a bit? Why would it want low convexity now?
Sure. So convexity, especially in options, is basically how sensitive your options price is to the underlying stock moving. It can ramp up fast, near expiration, or key prices. Low convexity mode means the system is deliberately stepping back from those big, potentially explosive swings. It wants more stable, predictable returns right now. It's trying to minimize sensitivity to sudden shocks, which fits perfectly with that preservation first idea in this adjustment phase.
Got it. Less chasing big swings, more protecting what it has. Makes sense. And the third action?
Right. The third is cash discipline. It's holding a really significant 44% cash reserve. And this isn't just sitting there. It's specifically labeled a mean reversion buffer.
Mean reversion buffer. Again, can you unpack that term? Why such a big chunk of cash set aside for that?
Think of it like a strategic war chest.
Yeah.
Mean reversion is just the tendency for prices to eventually drift back towards their average. So this buffer is cash ready to deploy if the market takes a sharp temporary dip. If things sell off hard, the system has almost half its capital ready to buy things cheaper. It's betting on that bounce back towards the average. It's a way to try and profit from volatility, but always from a position of strength, with capital protection baked in.
That's a powerful idea. After success, don't just coast, actively fortify and prepare. Okay, so besides these immediate moves, it's also tweaked its core risk rules. We're seeing much tighter controls, right? Max position size down to 3.5% from 5%.
Yeah, exactly. And total portfolio exposure capped way down at 12%. It used to be 18%.
And the stop loss is tighter too, minus 20% per contract. Even the really short-term stuff, the 0 DTE options, are capped at just 1.5%.
That's right. And this tightening isn't random. It shows a really deep-seated caution. It has these very specific kill switches built in, and perfection reversion triggers. These are designed purely to protect capital. And what's really interesting is how conditions combine, like the global kill switch. If SPY drops below $640 and the VIX, the fear index, jumps above 18, then bang, flatten all positions instantly.
Ah, so it's not just one thing breaking, it's a specific combination of bad signs that triggers the big red button.
Precisely. And it works on a smaller scale too. There's individual loss protection. If any single trade goes down more than 15%, that triggers a full defensive mode just for that asset. For Bitcoin, the gatekeeper, if the spot price falls below $113,500, it just gets out of that position. Done.
Wow, very clear lines in the sand.
Absolutely. And one rule is ironclad, non-negotiable time discipline. All those 0 DTE options have to be closed automatically at 3:00 p.m. Eastern. No ifs, ands, or buts. It's a hard deadline. Avoids overnight risk on those super volatile short-term plays. This whole setup just screams meticulous planning, layers of defense.
Okay, so with this very defensive, calculated approach set up, what's the system actually focused on trading today, September 12th? It says it's in balanced hunter mode. What's in its sights?
Right, balanced hunter. It's focused on a select group, each with a job title, basically. You've got SPY, the S&P 500 index tracker, that's the anchor. Then TSLA, Tesla, is the amplifier. BTC, Bitcoin, is the gatekeeper, traded via an ETF mini product. And finally, VIX is the fragility regime monitor.
And it specifically mentions other big names. NVDA, GOG, GLD are off the active list right now.
Explicitly removed, yes,
Okay.
unless reactivated later. For now, it's all about those four.
Okay, let's break those down. SPY, the anchor, what's the plan there?
For SPY, the bias is bullish, continuation if it stays above $653. It's actually looking for what it calls convexity ignition, somewhere between $655 and $60. That's the zone where its options might really start to pay off quickly. So the main play today is using September 16th expiry, $655 strike call options. First target T1 is $655. Second target T2 is $660.
And if things go south, what's the backup plan for SPY?
Always a plan B. If SPY dips below $651 and the VIX climbs above 16.5, it flips to defense. It'll use September 16th, $648, put options, see that combo again, price breakdown plus rising fear.
Right, the VIX condition again, and the absolute floor.
That's the kill switch we mentioned. SPY below $640 and VIX over 18. Game over for longs.
Okay, moving to TSLA, the amplifier. Why amplifier? What's the strategy?
Amplifier suggests it's looking for bigger, faster moves from Tesla, probably driven by momentum. The bias is for that momentum to continue above $370. The sweet spot, the convexity target, is between $375 and $380. So the main plan is using September 16th $370 calls. Target 1, T1 at $374 for a quick profit take. Target 2, T2 at $378.
Makes sense. And the downside contingency for the amplifier?
Yep. If TSLA falls below $360, and it does so with what the system called rejection volume.
Rejection volume, what does that signal?
It means not just falling, but falling with a lot of selling pressure, really pushing it down hard from a key level. It shows strong bearish conviction. If that happens, it brings out the September 16th $355 puts. And if TSLA breaks below $355, that's termed an amplifier breakdown. The whole bullish idea for TSLA is off at that point.
Okay, very clear rules. Now, BTC, the gatekeeper, you said it's more about validation.
Exactly. It's less about squeezing profit from Bitcoin itself and more about using it to confirm the overall market mood. The bias is bullish validation if spot BTC stays above $115,000 or the ETF mini version stays above $50.50. The main plan is just holding September 16th $116 calls, focused on that gatekeeper's strike level.
So it's like a canary in the coal mine for risk appetite.
Pretty much, yeah. A key signal for whether the broader risk-on feeling is still legit. And the contingency is simple. If spot BTC drops below $113,500, it just exits that validation position. Signal turn negative, act immediately.
Right. Which brings us to the VIX, the fragility governor. This sounds like the ultimate boss level.
You could say that. It's not really traded. It's the overriding check on everything else. It dictates the risk boundaries. The system only feels truly comfortable being risk-on if VIX is down below 15, as in calm. But if VIX ticks up above 16.5, that's the fragility trigger. It immediately activates those defensive puts we talked about.
And the hard ceiling.
Above 18. That's the kill switch zone again. Flatten all positions. The document literally says VIX overrules entries if fragility persists. So yeah, market fear measured by VIX trumps everything else. Individual stock ideas don't matter if the overall market looks like it's about to crack.
It's just incredibly structured. So how does it manage executing all these different levels and contingencies? It mentions tier ladders.
You think of tier ladders as a very detailed, step-by-step plan for managing each trade once it's on. It's a series of preset price levels, like rungs on a ladder, that tell the system exactly what to do. Take some profit here, add more there, get defensive at this point. It's all about taking the guesswork and emotion out of managing the position. Very rule-based.
Can you give an example, like for those SPY calls?
Sure. Let's take the main SPY plan, the Sept 16th $655 calls. Has a clear ladder. Rung 1, T1 is at $657. The rule. First trim, bank 50% of gains. Simple, immediate. Run 2, T2 is $660. That's the major convexity zone. Rule, Scale into the position aggressively here, add more contracts. Run 3, T3 is $662. This is called the dealer gamma wall.
Dealer gamma wall, what's that about?
It's basically a price level where big market makers, the dealers, often have a lot of options exposure themselves. They might have to buy or sell aggressively to hedge their own books around that price, so it can act like a point of resistance or acceleration. The system anticipates this. At $662, the rule is take 70–80% of the position off. Right. Drastically reduce exposure near that potential wall.
Wow, okay, so it's even factoring in potential institutional behavior. What's the top rung?
T4 at $665 is called the lottery extension. The rule here is only leave tiny runners, a very small part of the original position, if and only if the VIX is still calm, below 15. So even the most optimistic target is conditional on low market fear.
And this latter approach applies to the downside too, with the puts, and for Tesla.
Exactly the same principle. For the SPY puts, there's a ladder leading down towards that kill switch level. For the TSLA calls, similar tiers, like T1 at $374 is a quick bank zone, T2 at $378 is amplifier ignition, time to add size, maybe 50% more. But even its highest TSLA target, T4 at $385, has a condition. Only go for it if SPY is also strong, above $660, and VIX is low, below 15.
That double condition on the TSLA target really shows how interconnected it all is. Okay, so looking at the live dashboard summary notes for execution, what are the big takeaways?
They really hammer home the core principles. First, that profit banking at T1 50% gains banked on SPY and TSLA is mandatory. Second, time discipline. Those 0 DTEs must close by 3:00 p.m. Eastern. No debate. It avoids overnight decay and risk. Third, keep that cash buffer solid, around 40–45%, ready for reversions or pivots. Always have that dry powder. And finally, the combined market breakdown rule. If SPY and TSLA both roll over together and VIX is spiking above 16.5, the defensive puts immediately take priority over any lingering bullish ideas. It really is like a fortress with multiple layers of defense. So for this specific day, September 12th, what's the final verdict from the live dashboard on the market state? The dashboard calls the current market regime cautious risk on. VIX is sitting at 15.2. That's in the green zone, below that 16.5 fragility trigger. So the system is willing to take calculated shots on the long side. But the cautious part is key. All those protective measures, the profit-taking rules, the kill switches, they're all fully active. It perfectly reflects that post-perfection, protect the gains mindset. It's poised, but very wary.
Right. So boiling it all down, what are the main strategic goals for this cautious risk-on day?
Okay, in a nutshell, 1 for the SPY anchor, capture that convexity, ideally in the $655 to $660 zone. 2 for the TSLA amplifier, ride the momentum above $370, adding size between $374 and $378. 3, use the BTC gatekeeper to confirm the bullish feel above 115 tall gaze, but bail immediately if it breaks below 113 5Ks. And 4, watch the VIX monitor like a hawk. Green light below 15, yellow flag above 16.5, red light and full stop above 18.
So the bottom line feels like intelligent aggression, maybe, but with very strict guardrails.
That's a good way to put it. It's in balanced hunter mode, looking for opportunities. But the absolute overriding theme is profit protection first, convexity capture second. SPY and TSLA drive the potential upside. BTC gives a nod if the coast is clear, and VIX holds the ultimate veto power based on market fear. It's just remarkably disciplined.
It really is. What an amazing look inside such an intricate yet disciplined system. From that immediate aggressive profit banking to the layers of kill switches, the OM&I profit nexus shows this incredible mix of aiming high but being deeply cautious. It's not about gut feel at all, is it? It's all predefined rules, triggers, responses.
Absolutely. And, for you listening, whether you're involved in markets or managing a project or even just making daily choices, there's something powerful here. It's about the value of structured thinking. Having clear plans, backup plans, knowing your risks, and acting decisively based on preset conditions, not just reacting in the moment. Building that robust framework matters.
Definitely food for thought. And it leaves us with this one last idea to chew on. The system is in a post-perfection regime adjustment. What does it really mean, do you think, for any system, or even for us to be post-perfection? And how might that definition of perfection or the nature of the adjustment change as the future unfolds? Something to ponder. Thanks for joining us on this deep dive.